Hello and welcome. When you picture retirement, what do you see? Probably travel, hobbies, relaxing, not tax forms, right? But believe it or not, getting your tax strategy straight is one of the most important things you can do for your financial future. It's absolutely crucial for making your money last. So let's get right into it.
So let me just ask you this straight up. Is your retirement plan actually built to avoid some of the biggest regrets people have? I'm talking about those costly tax mistakes that, a lot of folks don't even see coming until it's way too late. Today, we're going to walk through the 4 biggest ones that financial planners see, and more importantly, how you can steer clear of them.
And look, this is exactly why we're talking about this. A tax mistake in retirement, well, it's not a one-and-done thing. It's more like a slow leak. It's an error that just keeps on costing you, year after year, and it can seriously eat into the nest egg you spent your whole life building. I mean, when you're on a fixed income, every single dollar counts, right? That's the name of the game.
All right, so let's get into it. Retirement's hidden tax traps. When you're working, your taxes are usually pretty straightforward. But once you retire, whoa, things get a lot more complicated. And that's exactly why tax planning suddenly becomes more important than ever. It's all about protecting what you've got.
Okay, so here's regret number 1, the RMD bomb. And yeah, it's pretty much what it sounds like. It's this ticking tax time bomb hidden inside your retirement accounts. If you don't know what's there and you don't defuse it, it can go off and create this massive unexpected tax bill. Not exactly what you want in retirement.
So what in the world are RMDs? Well, RMD stands for Required Minimum Distributions. Basically, it's the government saying, hey, you've had that money growing tax-deferred for decades, now it's time to start taking it out and paying taxes on it. You have to start taking them, usually at age 73. And the kicker is, every dollar you take out is taxed as regular income. You add that to your Social Security, maybe a pension, and bam, you can find yourself in a much higher tax bracket than you ever planned for.
But, and this is the good part, there's a really smart way to defuse that bomb. It's all about this sweet spot called the Roth conversion window. Look at this timeline. It's that period of time after you stop working, but before those RMDs start at age 73. For a lot of people, these are your lower income years in retirement, and that's a golden opportunity.
So what do you do in this window? You do what's called a Roth conversion. You're basically taking money from your traditional IRA or 401k and moving it over to a Roth IRA. Now, yeah, you have to pay taxes on the money you move right then and there, but here's the genius part. You're doing it during those years when you're likely in a lower tax bracket. And the payoff is huge, because once that money's in the Roth, it grows tax-free, and every single cent you pull out later is 100% tax-free forever.
All right, let's talk about regret number 2. This one's for all the generous people out there. It's about charitable giving. So many retirees are missing out on a massive tax break, and it's not because they aren't giving, it's because of how they're giving. This is all about giving smarter, not harder.
The secret weapon here is something called a Qualified Charitable Distribution, or QCD. So if you're 70 and a half or older, this rule lets you send money directly from your IRA to a charity you care about. And here's the magic trick. That money never even shows up on your tax return. It's completely excluded from your income. It's like it was never there.
And this just shows you the night and day difference. So here's what most people do. The mistake. They pull money out of their IRA, which gets added to their income, they pay tax on it, and then they write a check to the charity with what's left. The smart way, the QCD, the money goes straight from the IRA to the charity. No tax hit for you. It's a total game changer. Plus, it can count toward that required minimum distribution we just talked about. It is a win-win.
And this isn't some obscure thing. Financial planners talk about this all the time. They say, I've seen seniors take out distributions to themselves and then give to charities, and they are missing out on a great tax strategy. It's so common, but it's also so easy to fix, and it can save you a ton of money in taxes while you're still supporting the causes you love.
Okay, moving on to regret number 3, leaky investments. I want you to picture your investment portfolio as a big bucket holding water. You want that bucket to be solid, right? But some types of investments create these little tax leaks, these surprise tax bills that just slowly drain your money over time without you even realizing it.
So what kind of leaks are we talking about? Well, a classic example is looking at traditional mutual funds versus ETFs, or exchange-traded funds. The way a lot of mutual funds are built, they often have to buy and sell stocks internally. And when they sell for a profit, they have to pass that taxable capital gain onto you. It's a tax bill you had no control over.
ETFs, on the other hand, are just built differently, and they tend to be way more tax efficient, spitting out way fewer of those surprise capital gains.
And what this all boils down to is control. See, by using more tax-efficient investments, you get to be in the driver's seat of your taxable income. And listen, this isn't about throwing out your entire investment plan and starting over. No way. It's just about being smart and strategic, plugging those leaks so you can keep more of the money your portfolio earns. All right, that brings us to our fourth and final regret. And honestly, this might be the most important one of all. It's about withdrawing money blindly, without a real plan. Because in retirement, where you pull your money from can be just as important, sometimes even more important, than how much you're taking out. Think of it like this. Most of us have our retirement savings spread across 3 different money buckets. Bucket 1 is your taxable bucket. Think of a brokerage account. Bucket 2 is tax-deferred. That's your traditional 401k or IRA. And bucket 3, the holy grail, is your tax-free bucket, like a Roth IRA.
So, here's the million-dollar question. Which bucket should you dip into first? Does the order even matter? Well, yes, it matters a lot. Just blindly pulling money from, say, your 401k every time could be a massive mistake that just blows up your tax bill for no good reason.
The whole point is to have a coordinated withdrawal strategy. You want to be able to pull a little from this bucket, a little from that one, all to carefully control your taxable income each year. And this isn't just about a smaller income tax bill. Oh no. It's also about avoiding those really nasty surprises, like higher Medicare premiums, what they call IRMA, which kick in if your income gets too high.
Whew, okay, that was a lot, I know, but it's super important stuff. So let's wrap this all up with a simple checklist. Think of this as your game plan, the key questions you should be asking your financial advisor. Here it is, your 4-point SMART tax checklist. First, look into Roth conversions before those RMDs start. Super important. Second, if you give to charity and you're over 70 and a half, absolutely use QCDs. Third, give your portfolio a checkup. Is it as tax efficient as it could be? And finally, number 4, have a plan. Create a coordinated withdrawal strategy so you know which bucket to pull from and when. So I'll leave you with this to think about. Your retirement could easily last 30 years, maybe even longer. You spent your whole career building up your nest egg. So the real question is your tax plan built to last too? Is it strong enough to protect that money for the long haul? Thanks so much for joining me.